Welcome back, everyone. Today we're going to talk about a new topic this week for about bonds and interest rates. If you're not familiar with, we had a previous video on bonds, the government or the corporations, and that would be the child who initiated the agreement. Now, how is a bond? To just kind of explain the mechanics of a bond, what are the basic things you need to know. But just for a quick review, there should be about 4 things you need to know about bonds. So 1 is that a bond is a fixed income investment. 2 is that a bond has a par value. 3 is that there is an interest rate, just like we're going to talk about today, or what's known as a coupon. And then 4, there is a maturity date. Now, we have a Verse of the Week video with Crazy Bone talking about bond credit ratings as well. And we have another video, an educational video on bond credit ratings. So that's another element, but these are the main 4 things you'll need to know. And so with the fixed income investment, you'll hear a lot of times, oh, equities and fixed income. Well, fixed income particularly is referring to bonds. And that just means that you get a consistent amount of money over a consistent period of time. So say, for instance, let's kind of go through real quick and then I'll give you an example. So for par value, that's just how much, par value is how much you spent to basically buy that bond. Interest rate is how much money you're going to make on interest on your par value. And then lastly is maturity. When is the bond going to terminate and then you get your par value back? And so with a fixed income, so you have your par value of $1,000, so 1,000, and you have an interest rate or a coupon of 10%. That means that usually a bond is going to pay their interest out. The interest is over the course of a year, but they're normally paid out every 6 months, unless you have like a note or a bill, and those are usually tend to be less than a year. So it just depends. And then you have a maturity date of 30 years. So if you have a par value of $1,000 and you're going to make 10% per year, you're going to get $100 per year over 30 years. And that $100 is going to be broken down into 2 payments every 6 months of $50. So now you're going to get a fixed income payment of $50 every 6 months over the course of 30 years. And that's the basic mechanics of how a bond works. So now into today's lesson, we're going to talk about how interest rates, not the coupon, but economic interest rates affect bonds. And so with bonds, remember I mentioned that you have a par value. So let's say you have a par value of 1,000, okay? And you have that coupon of 10% still. So you spend $1,000, now you're getting this interest rate per year of 10%. And, you know, the interest rate currently in society is, let's say it's 1.5%. That's the economic interest rate, not your bond coupon. So let's say the Federal Reserve, now the Federal Reserve is the central bank. If you think about when you get a loan from a bank, they're going to give you an interest rate that you pay back, and that's how they make money. Well, the country's banks actually borrow money from the Federal Reserve, and they charge an interest rate to the banks, and that's how the Federal Reserve makes money. So if a Federal Reserve has an economic interest rate of, let's say, 1.5% to banks, most likely a bank is going to charge us an interest rate higher than 1.5%. You know, that value can vary, but more than likely it's going to be higher than 1.5. Otherwise, they're not going to make any money. If they charge less than 1.5%, they're actually going to lose money. And you may have heard about negative interest rates maybe coming around with savings accounts, and that's definitely not a good thing. So if you have a par value of $1,000 and a coupon of 10%, so you make $100 per year, but the current economic interest rate is 1.5%, let's say all of a sudden the Fed says, we're going to increase this interest rate to 2.5%. Well, what's going to happen is, think about it. If the Fed is loaning money to the banks on an interest rate and the banks loan it to us, just like those interest rates affect the bank's interest rates, those interest rates are going to affect the bond interest rate or the bond coupon. So if you have interest rates going up to 2.5%, most likely the coupon interest rates are going to go up. So let's say now this coupon interest rate went up to 12%. Okay? So now you have where you have a bond that has a coupon or an interest payment every year of 10%, but on the open market, bond interest rates are going for 12%. So if you think about it, normally you're going to hold a bond until its maturity date, in this example, 30 years. But let's say it's been 10 years and you want to just go ahead and get rid of that bond. You don't want to hold it and you sell it. If you think about it, your bond still is going to have this 10% fixed income rate, but the open market has a 12% fixed income rate. Now, I don't know about you, but if I see someone selling me something and I'm only going to make $100 per year and they sell me the same thing at the same price and I can make $120 per year, I'm going to get the one that's going to give me $120. So what happens is now that the coupon interest rates have gone up, the par value of your bond is going to decrease. And the reason that's going to decrease is because there's less demand for your bond. And so for you to be able to get rid of it, you got to kind of give it away at a discount. So now let's go ahead and break this scenario down here. You have this par value of $1,000. Interest rates just went up from 10 to 12%, but you don't want to hold this bond any longer. So if the interest rates go up, now let's say your par value is only going to be worth $900 in the open market for your coupon of 10%. That means that you just lost $100 on your par value if you sell it before maturity to the open market. In the open market, I mean just like basically me selling it to you, you selling it to me. That's what I mean by the open market. And so now your bond is only worth $900. So you just lost $100. But remember, I said that you had it, let's say, over the course of 10 years and you wanted to sell it. So over the course of 10 years, you got 10 years and you made $100 per year. So that means that you would have made $1,000, right? Wrong. You're really only going to make $900. And why is that? Because you just lost $100 on the par value of your bond for selling it in the open market. So now you just lost 10% of the money that you made over the past 10 years simply because you wanted to get rid of the bond early during the time that the interest rates increase. So to kind of sum everything up here, when bond prices increase, let me say this the other way around. When interest rates increase, bond prices are going to decrease. And the opposite is also true. When interest rates decrease, bond prices are going to increase. And what happens is the opposite is true. So if you have a 10% coupon, interest rates go down. Now bonds are being offered only for 8%. You can charge an extra premium on top of your $1,000 par value because you have a bond going for 2% higher than what's going for on the market. So if you think about it, it works just like a stock. If you buy a stock at, let's say, $50 and you sell it for $55, you made an extra $5 because that's the going price. With a bond, it just is all dependent upon the interest rates, but now your par value, which is kind of like your stock or share price, is going up or going down depending upon it. So that's how bonds and interest rates are correlated. And so when you think about it, a lot of people are saying to buy bonds currently in this economy. Well, the Federal Reserve increased the interest rates. So that means that bond interest rates are more likely going to go up. Or bond interest rates are likely to go up. But that means that current bond interest rates aren't going to be as attractive, causing those bond values to go down. And that is the correlation between interest rates and bonds. Make sure to check out the previous videos that we have on some bond basics as well as on bond credit ratings, because a bond credit rating is just like your credit score. You have investment grade and you have junk bonds. So make sure to check out our verse of the week featuring Crazy Bone from the song Hook It Up about bond credit ratings and the difference between investment and junk grade bonds.